Hey, Steve Saretsky here. As always, Canadian real estate market update with particular focus on Vancouver. If you sort of value or intimate out of these videos, all I ask you a thumbs up and subscribe. Questions, comments, put those below. First video of the new year. Thanks for your patience. Took a couple weeks off there to enjoy the holidays. Hope everyone had a great time. But back in the saddle and kind of wanted to start this week's episode off. Really just sort of looking ahead into the Canadian housing market, things that I'm looking at, things to sort of interpret. Again, I'm not here to sort of forecast tops and bottoms, but really to sort of provide the data, the facts, and help people make an educated decision. I think the more information that you can have, it kind of opens up your mindset to different outcomes. I think is really what I'm looking at is different outcomes. I'm always asking myself, how could I potentially be wrong? Where could my thesis potentially go wrong? And so, one of the things I want to start off with was to start the new year. I did a poll on Twitter, just trying to gauge where sentiment is, because sentiment naturally is so negative on Canadian housing. And I understand. I mean, the valuation metrics are off the charts. It's been a housing debt bubble that we've been talking about for 15 plus years. Everyone's been waiting for the bust. We thought it was going to come during the pandemic when everyone was losing their jobs. It turned out not to be the case. Now you've got the fastest rate hiking cycle in modern history. Surely that's finally going to be a straw that breaks the camel's back. So I really wanted to gauge, where sentiment was. So I put out this poll on Twitter. Nearly 5,000 people responded to it. Now, again, maybe Twitter's tends to skew maybe a little bit more bearish, but the overwhelming consensus was over 70% of participants suggested that there's decent amount of downside still to come in the Canadian housing market. Now, again, this poll, I asked people for the declines expected in the national house price index, not the average sales price of the GTA or a suburban market somewhere, the national home price index, which is a hedonically adjusted, smoothed out index which adjusts for volatility and the change in sales composition. Now, what I have to remind people, because I got people commenting on that, well, it's going to drop at least 50%. Guys, in the depths of the global financial crisis, the Case-Shiller index in the US dropped, I believe, in the worst year, I think 08, 09, it dropped 14%. So a 15% national decline is nothing to sniff about. That is a significant movement. In fact, if I have to remind you again, the National House Price Index, since peaking in March of 2022, dropped by 16%. 16% since March of 2022. That's the largest decline since the index was created in 2005. So we've already had a pretty large correction from a national basis. So I certainly think there's more downside to come, but Twitter is polling 70+%. I'm a little bit skeptical of being along consensus. I think when the market's all leaning one way, I tend to find that the opposite ends up happening. Now, I don't want to be contrarian for contrarian's sake, but it's something to think on, because I'm always asking, where can I be wrong? Where can the thesis be wrong? So if everyone is positioning incredibly negative, maybe all it takes is a little bit of good news, a little bit of unexpected news to suddenly change sentiment. Now, again, I'm not saying this is a foregone conclusion. I'm just saying these are things to think about. One of the other things I was thinking about the other day was everyone's calling it like, it must be this or it must be that. There are a range of scenarios and outcomes that could possibly happen. Like I said, we're already down 16% since peaking. Maybe the National House Price Index dropped another 5, 10%. And maybe it moves sideways for a decade. Has anyone thought about the ramifications of national house prices moving sideways nowhere for 10 years? Consider this is exactly what happened in the 1990s. The national average home sale price was basically moved nowhere. It moved nowhere for 10 years. So is this a possible scenario where maybe we get no growth for 5 years, 6 years, 7 years, maybe we get no growth for 10 years, and that allows wage growth to pick up? Maybe you get 3% annual wage growth, you get inflation running at 2.5%, 3.5%, and suddenly on a real adjusted basis you could be looking at a 10, 15, 20% on a real adjusted basis decline in national house prices as wages pick up, and that thus creates affordability in the long run. So I don't think it's a binary decision of like must drop 20% or must bottom, and it's going to bottom in 6 months from now, and then it's going to be back up to 10% annual increases, which was what we're used to. I think the last 10 years have been historically not normal. A 10% growth per year in markets like Vancouver and Toronto they're not normal, and I don't think you should expect them to be normal. I mean, you guys know that I do a lot of investing in the Calgary real estate market. I mean, that's a market just up until recently was moved sideways for about 10 to 12 years. So to think that this can't happen in our sort of more exuberant markets like the Vancouver and Toronto is something I'm certainly keeping an eye open on. We're going to get some more clarity, though, very, very soon on the way the housing market is going to shift and the way it's going to play out. We won't get that sense really until the spring market. Like, we're still kind of on pause here in January. Realtors are still on holidays. Clients are still on holidays. But people are starting to gear up. They're starting to plan. We've got buyers. We've got sellers right now. Sellers are saying, okay, we're ready to list. Let's have that consult. Let's get the marketing sort of prepped and ready to go. And so you're going to start to see the next pickup in the housing market is really towards the end of February. That's your spring market start, and it'll go through March, April, May. That is historically the busiest time of the year for not only new listings, but also sales. So we're going to figure out where's the demand, where's the new listing. Are we going to continue to see low levels of new listings, which is going to suppress inventory levels? Or are we finally going to get that wave of distressed sellers, which everyone's been talking about, given the huge and fast, rapid pace of change in interest rates? So we're not going to get the next direction in housing really until the spring market. So, you can basically tune back in March and we'll have a little bit more clarity. But in terms of, what we're looking forward to in the next couple of weeks, anyways, we've had some data. We've got the Bank of Canada coming out January 25th, the next rate hike decision. Interestingly enough, there continues to be strong labor statistics in Canada. So we just had a data dump today. I think Canada added something like just over 100,000 jobs in the month of December. Now, something to keep in mind is that number came out the same day the U.S. reported. And so the way it read was that the Canadian economy added half of the jobs that the U.S. did. Yet our population is 1/10 of the size. So it doesn't quite square. And I've said this from the get-go, whether you want to present the bullish data or the negative data, Stats Can labor statistics are horrendous. So I really do take them with a grain of salt. The labor data just doesn't square with a lot of the other data that we're seeing coming in. So all you have to do is look at the Canada IV PMI data that came in, at 33. This is a diffusion index, came in at 33 in the month of December, down from like 48. So in massive contractionary territory, one of the worst readings in several years. And then, on the same day we had US PMI data. So Purchasing Managers Index, it's essentially a survey, and the PMI has always been a great leading indicator for determining recession. So anytime you kind of go below 50 on the diffusion index, tends to give recessionary signals, or basically indicates that the recession is already there. And so we had the goods PMI had rolled over to around 48, I think, over a couple months ago. But services was sticky, and so it just went from about 55 to 49. It was way below consensus expectations. Shocked the market, and of course, the day that I'm recording this, the stock market is way up. And well, why is it way up? Because people interpreted this and said, "Holy crap! The economy." The PMIs are rolling over. The U.S. Federal Reserve is going to see this, and they're going to pause or slow. They're going to slow the pace of their rate hikes. Now again, maybe that's right, maybe that's wrong, but that's how the market is interpreting the data, is that the Fed is going to have to slow their pace of rate hikes because the economy is clearly rolling over, which is funny because again, it kind of contradicts the labor market statistics, but labor data has always been historically lagging. So if you're looking at data numbers coming through in the jobs reports, it's not a forward-looking indicator. Now I understand that the Bank of Canada is certainly going to be looking at that data and saying, well, the labor market hasn't cracked yet, so we can continue to justify higher interest rates. So personal view, not sure how the Bank of Canada is going to opt to determine this data. Me personally, I interpret it as the economy continues to slow, continues to roll over, as one would expect with interest rates going up 400 basis points and with housing being such a large component of the economy rolling over, as we know, that it should be no surprise that the PMIs are obviously rolling over. And I think it's just a matter of time until the labor market follows. Now, keep in mind with those 100,000 plus jobs that were added in Canada, I mean, we continue to pile in more and more immigration, so that can kind of cover over some of this and make the jobs numbers look better than they probably should as you continue to add more and more people to the economy. I mean, look at this chart just on population growth on a percentage basis compared to the US. I mean, it's completely off the chart. So we're basically papering over a lot of the problems in the Canadian economy, right? The lack of productivity. If you look at real GDP growth on a per capita basis, it's gone flat for basically a decade. So what that basically is saying is people's living standards haven't actually gotten any better. They've been flat. So you're basically your lifestyle on a per capita basis not really improved. There's really been stagnation. So we're not growing. We're not getting more prosperous as a society. And I think in general, I think most people can probably agree with that, right? I mean, high house prices that are becoming unaffordable, the cost of living continues to go up, people are having fewer and fewer children because they can't afford it. I think in general, we can probably agree people are working more, having to take on second jobs, because we're just not growing productively anymore. And again, you can see that on a real adjusted per capita GDP basis. So, that's kind of what I'm looking at this week. There's a lot of noise out there. Everyone's trying to figure this out. I don't have the answers in terms of exactly how this is going to play out. I think there's an incredible amount of smart people on both sides that are looking at the labor data. They're looking at the PMIs. They're looking at, what the Fed may or may not do. And everyone's kind of coming to slightly different conclusions. I've got my own opinions. They're just that. You guys know that I continue to believe the economy will roll over and that bond yields will follow that. You'll see lower borrowing costs, I think, over the next 3 to 6 months. Maybe not significantly lower. You're not going back to those 1.5% mortgage rates, but I think we get that recession, lower bond yields follow. And there's nothing ruling out a double top of inflation 12, 18, 24 months from now. But in the near term, these interest rates are going to do their job. So hope that helped. See you next week.